Hello, everyone. It's my pleasure today to be joined by Francisco Mainez, who's the Global Head for Data Analytics and Financial Crime at HSBC, and apparently many other things as well. So, Francisco, it's great to have you here. Thank you for joining us.
Hi, Tony. Thanks for having me. Real pleasure to be here.
So we're just going to have a canter through a range of questions, really to allow you to share some of your insights. You were due to be doing a fireside chat with us before one of our events, and sadly fell down not with COVID, which you've already had, but with the vaccine malaise. So bad luck. Glad to have you back and glad to have you well. First of all, why don't you start by talking us through your work at HSBC, really focusing on the rollout of advanced analytics, the initiative you've got there with financial crimes and the fraud typography library as well, please.
Yeah, happy to. I've been currently in this role for 4 years now, a little bit more than 4 years actually, building the team that does data analytics for financial crime in the largest line of business in HSBC for wealth and personal banking, which is actually the fusion from retail and private banking. One of the big things that we've been working on over the last few years has been trying to migrate from rules-based engines into a more advanced analytics solution based around an algorithm, and try to also combine it with efforts in parallel to improve our data quality or improve our data collection capabilities. And the ultimate goal was actually nothing less than try to become more efficient in the KYC segment, and also try to review the customers that we really need to review. And I'll give you an example. Imagine that now your company says, Tony, we're going to move you to our office in the US, for example, because you are moving from country A to country B. Most likely we're going to review you as a customer, because that's something that customers typically don't do or don't do quite often. Now, 90% of those reviews end up by us finding out or coming to the conclusion that Tony's a good customer, never been in trouble, never had any suspicious activity report raised against him. The only thing he's doing is moving, probably following a job opportunity. And what we try to do is integrate those type of, let's say, events or those type of, risk indicators into an algorithm that what's going to do is going to give you a score. And now the score will have a treatment linked to it that will say, this is what we're going to do with this customer after the review, depending on the score he or she gets. And going back to the previous example, now you're going to move countries, you're going to score so low because you haven't been transacting with high risk markets, you haven't been transacting with high risk products, you never had anything bad in the past. You're going to score so low that we'll say, we don't need to review Tony. And now you multiply that by thousands of customers, and you come up with a framework that is much more cost effective because you're doing less reviews, and is much better aligned with your risk management framework, because in reality, you are reviewing the customers that are scoring high in the algorithm, and those are the ones that should worry you and you should definitely review. And all of
So I can see the commercial rationale, and cost efficiency, optimization of resources, speed of decision making. Brilliant. What about from the customer's experience point of view?
For the customer's experience, what happens is that because you're doing less reviews, you also minimize friction with the customer, and also because what I mentioned before, that we're trying to improve customer quality. Data quality. We're trying to improve also the way we collect data on our customers. You are also reducing interaction with the customer, the typical interaction with the customer that they tend not to like, which is telephone calls. So you try to gather data based on the different interactions we have with the customer, using the transactional data, enrich the data you have, put it up to date, put their KYC profiles up to date. So in that way, you reduce the interaction, the undesirable interaction, if you like. And I'll give you another example. Imagine that you join a company as a university graduate, and you are on this XYZ salary. 5 years later, you have become a successful senior manager. If your KYC system your KYC profile has not been updated in the system, what happens is that you're going to be providing your transaction monitoring system with an image of you that is 5 years ago. But you have done other things. Maybe you have bought a villa in southern Spain, but because the system thinks, how come someone with this level of income is able to do this transactional activity, and then it's going to flag you up. So one of the very keys of this is make sure that your customer profiles are up to date, because then you're going to you're going to put them through the black box, through the algorithm, and the algorithm really needs to know that that data is up to date and preferably high quality. Again, one of the things that we need to know, and sometimes we lack, is updated employment data. If you feed your algorithm with that bad quality data, you're going to get bad results. You're going to get skewed results.
Yeah, and I think this must be really helpful on many levels. We've been hearing a lot recently about artificial intelligence, and to what extent would you say this is a step towards the point at which the machine is actually learning and becoming in itself intelligent? And how far away from that utopia are you?
I would probably say it's a stepping stone. It's definitely the foundation, and it's been, I think, a significant move forward into that direction. Now, how long that's gonna take us? How much is it gonna take? Which is probably another, very very interesting question that I don't know. Time will tell. And again, you probably read that we're still going through these, internal restructurings, but I would definitely say there's no way back. And after this, we don't want to go back to a system that already created enough headaches, and something that we have already proven that we're more efficient doing things this way.
Brilliant. Well, no, I know you can't go back to an old technology once you've enjoyed the benefits and fruits of a new one, can you? So let's talk about new tech. What's your thoughts on crypto? I mean, the Payments Association is soon to be launching a paper on what we're calling a new era for money. A big ambitious project around transforming the way in which money moves digitally and whether the central bank digital currency is feasible or not. What's your views on this? Is this a flash in the pan? Is this here to stay? What's your views on these new technologies?
I think crypto is here to stay. Very short. Crypto is not going to go. It's not going to go away, because it's already providing benefits in areas like inclusion in segments of society that they were really struggling to be included in let's say the traditional banking industry. What I think is going to be a challenge is in the industry is first understanding what are the implications of having to coexist with crypto, and as crypto evolves and the obviously the regulation that is going to oversee crypto evolves, how prepared are we to put in place controls that are going to give us the assurance that financial crime typologies are being adequately managed in terms of crypto. And we're saying that we're going from talking about just Bitcoin a few years ago, and now a whole variety of virtual currency exchanges. Now we're talking about stable coins. Now we're talking about central bank digital currencies. We're seeing that from Russia to Chile, many countries have started to look into CBDCs in different phases of rollout and testing. We've seen China that has coupled the CBDC plans with a sweeping ban on cryptocurrency. So it's going to be really interesting, and what I believe is going to be real challenges for institutions, not only to gain knowledge on how this works, but how we're going to adapt and how we're going to live with this. When people were facing me with or throwing comments about, you think crypto is going to stay? And said, I think in the 1870s, some people were faced with a similar question with, do you think plastic money and credit cards are going to stay? And the answer has been yes.
Yes, indeed. And the questions in the early stages of the World Wide Web were, is this going to be safe and secure and beneficial, and is it not going to be abused by big technology companies, etc.? And overall, it's worked pretty darn well for the whole world. We've all benefited, and I think we're on the edge. Personally, I think we're on the edge of a huge breakthrough in how these new technologies are helping to make the world work, which is cool. And of course, that's really all about helping consumers, isn't it? At the end of the day, I mean, to what extent how well are the consumers that you're dealing with adapting to this new reality of new technologies and new means of paying and things?
Absolutely, and the reality is that, and one of the things actually has been COVID. COVID probably has been a catalyst to move into having consumers more digital aware. They put us at home. They basically told us you can't go out and do the things that you used to do. So now you're going to do everything from home. So now we're facing hybrid working models. we're facing an increase of interaction through digital channels, and obviously the industry, from a financial crime standpoint, we're going to have to be able to adapt to this. One of the keys, or one of the things that we've been trying to do in the team here, has been adapting our financial crime typologies library. We launched that a few years ago.
What is a financial crimes technology library?
A typology library is essentially what are the things, the way we approach building up the typology library is approaching in an organization like HSBC, where you have retail banking in something like 35 countries. What we did is approach the financial crime teams and told them, what are the things that keep you awake at night? Because if we try to do this from the big ivory tower in Canary Wharf in London, that's never going to work, because you're going to have countries like Malta with worries, financial crime worries, much different to something like Singapore, where probably they're going to be more worried about things like trade-based money laundering, where in Malta is about money mules or human trafficking. So we went there and we told them, what are the typologies in financial crime that are on top of your agenda? And they told us. So it was a massive engagement exercise. And we told them, we're not going to change anything from here, but we're going to have an oversee function, from the center. So one of the things we did was actually embed the key risk indicators from that typology library into the algorithm that I mentioned before. So every country, if you imagine, every country has a different version of the algorithm, which is aligned to the different particularities. We also use that typology library for things like training, to make sure that when you are talking about when you're training transaction monitoring teams to check alerts. And typically what you have is a team covering one country or two countries in the morning, and the same team covering two different countries in the afternoon. They have different lenses to look at the countries, and those lenses are aligned with the typologies library. So essentially, it's how, in theory, a financial crime works. So if you're looking at money mules, your typology would tell you, these are the risk indicators. These are the data points coming out from those risk indicators. We went to the point of mapping those data points to the systems and said, and when you will need to find, for example, this particular habit or this particular red flag in transactional activity, you can find it in the system, and this is how it manifests.
Brilliantly. It sounds invaluable, but it also sounds very expensive to put together.
Well, more than expensive, I would say, is very labor intensive, because it's something that you cannot just leave and basically revisit every 12 months. Which is something I would probably say 10 years ago we would have probably reviewed that on an annual basis. Now you need to review some of them almost every week, because things change a lot. And back to the original point on customer habits. You're basically looking at two crucial things here, or two key things. One is having your typologies library that is telling you, when customers are doing this, it could be aligned with these financial crime typologies. But the other one is the ability to capture the data that those customers generate and be able to compare those data in two different points in time. And when you see the divergence between point A and point B in a particular segment of customers, and you don't have a behavioral causality for it, then you need to start worrying, and you need to start, delving into it and say, what are this segment doing that is not really mapping to any kind of external event like COVID or any kind of other circumstance that is not explained, and then you need to start doing analytics on it.
So look, this has been a fascinating run through. I think you've got a brilliant job by the sounds of things. It sounds very exciting. We've talked a bit about consumers. We talked about data. We've talked about some of the things that you're doing to help to make it easier, better, quicker, faster for you to give your customers what they want. There's something that criminals want, which is money, and they want money from your customers, and they're particularly good at getting it, increasingly good, it seems, at getting it, particularly around authorized push payment fraud, which is the most ridiculous term I've ever heard, but it means people taking money from you, kind of with you involved with it. It's an emotionally traumatic, it's a deeply unpleasant and detestable thing to do, and it's unpleasant to have it done to you. It was almost done to me just the other day. What's happening with this? The HSBC? How much is is this a concern to HSBC, and to what extent do you think our industry is doing enough about it?
I think as an industry, one of the things that we should be probably looking at is try to see convergence points between AML and fraud. I agree, completely different activities. You're looking at fraud, which traditionally has been a line of business activity, fight against fraud, because it impacts precisely that, let's say the flotation line of your business. Whereas AML has also, money laundering has also been looked at in a more retrospective way. You basically let the transactions flow, and then you analyze, if there's any anomalies in that. Now, with I will probably say, two things are influencing that progressive merge of one to the other, at least from an operational perspective. One is that the bad guys do it. You don't find, if you go to fraud in any company, and you say, "Can I have the fraud data?" and you say, "But you're AML." Say, "Yeah, but can I have fraud data?" Sometimes you're going to get like, "No, because you're not part of my business function, so I cannot share it with you." And that's something that, but it's something that one of these internal silos or obstacles that we're trying to reduce. So, but initially the approach or the answer, especially years ago, could have been like, "No, who are you?" Especially in an organization where you have, many thousands of people working at different levels, global, regional, country. Now we're trying to get rid of that and try to, pull in data, because the bad guys do it. You're not going to find the bad guys doing. So you do money laundering and said, "Yeah, because I don't do fraud. Fraud is John on the other side." I said, "No, they do everything." And I also understand that because of the nature of how it works, fraud tends to be more linear activity. I'm going to go in there, I'm going to take some money, and then I'm going to move on. Whereas fraud tends to be, money laundering tends to be a more cyclical activity, a more transactional based. But again, because most of these things are transactional based, and most now, because among other things, COVID, are being done on digital channels, I think there's a vested interest from the whole industry to look at those things, despite the challenges and the operational and legacy systems, legacy structures, and everything. Brilliant. I think there's a vested interest, to look at these things, from a more, overarching view, if you like.
Brilliant. Thank you very much indeed. We have to tie up. We've had our time. Thank you very much indeed for sharing your insights, your nuggets of wisdom, Francisco Mainez from HSBC. Thank you for your time. Thank you.
Thanks to you. Thanks for having me. It's been a pleasure. Thank you.